Nice rally in the grains on Wednesday with the cattle market setting back. Kent Beadle is joining us with analysis. Kent, let's talk about the rally in grains. Corn new highs for the move. Are we putting in South American weather premium there?
Oh, we absolutely are, and we're just very, very slow in getting the safrinha crop planted. CONAB actually issued a report yesterday that suggested that this is a historically slow planting progress pace. That's something less than just a little over 1%, with only 4% of the soybeans harvested in Brazil. So, we got a long ways to go. The longer that things wait, the higher the risk is that a good portion of pollination and grain fill in the safrinha crop is going to occur during their dry season, and that's just really bad for yield. We have a very, very tight world stocks to use balance sheet when we strip out China. It's the tightest it's been since 1995-96, and quite frankly, I just don't think that that's something that has been priced in at all, and that many traders have appreciated. But now, with the slowness of the Brazilian crop getting into the ground, I think traders are starting to realize it, and maybe appreciate what the risk really is here.
I mentioned corn made new highs for the move, closed above that previous high, that 495 resistance area. So now where do we project to?
Yeah, so the next level of resistance on the continuation charts is at 509. That was a high from the middle of October in 2023. So we're already, on a continuation basis into highs that we haven't, or levels that we haven't seen for, the better part now of about 14 or 15 months.
So the soybean market has been kind of a reluctant follower. Is it treating South American weather as well? And can soybeans get above the previous highs?
Well, there is resistance. Okay, we've got a 200-day moving average at 1073, and that stopped the market the last time up. We've got 4 daily highs from last week that we still would have to climb above, as well as that 200-day to really get the market to giddy up and go. That being said, we do see that crush margins have been holding in there very well. They're 40 cents a bushel better than they were at this time a year ago. We see meal prices starting to rally again. We heard social media reports this morning that meal actually pencils into Brazil coming out of the Gulf of Mexico from the U.S. That's a very rare occurrence. It just goes to show you how tight world meal is, and that everyone is waiting for this Brazilian crop, not just to get harvested, but to be processed and for some of the products to be available. And it's just not happening very, very quickly. I will add one more thing. Early yield results still continue to be a little disappointing in Mato Grosso.
So is that enough to get us above that 200-day moving average in the beans that we have had such a difficult time getting on the charts?
My gut is that it will be. My gut is that it will be. It just may take a little bit of time, and maybe a couple more attempts from the speculative side of the community. But we have to keep in mind that soybean prices themselves are still well below cost of production. And as we start to look ahead toward next year and what we might be planting in the United States, if we don't see better soybean prices, i.e. if we can't get our futures through some of these major moving averages, we're going to see acreage down maybe 3 million acres and maybe even more. And that would actually pencil out to the 25, 26 balance sheet, maybe moving right back down to pipeline.
So we'd had some double-digit gains. Was it just following corn today, or was this end of the month short covering by these funds?
Well, keep in mind here again that wheat prices and corn prices have now kind of converged. And, if corn is going to rally, it's going to find some support from those higher corn prices, because we're starting to price wheat into the feed ration. Add to that the fact that the speculative position in wheat remains extraordinarily short, whereas, the corn position, of course, has been covered and the funds are very long. The soybean position has been covered, but they haven't covered the wheat position yet. We challenged some moving averages again today. Kansas City managed to climb back above its 100-day moving average. Minneapolis and Chicago closed yesterday above the 50-day, and both of them are now challenging the 100-day as well.
So if corn is in a bull market, is that bull market strong enough to keep pulling both soybeans and wheat along with it?
So I think that they can, yes. Again, if you see where the South American corn crop loses 5, 10, 20 million tons due to weather, that's an easy 50 cents to $1 in corn. And that just in and of itself will pull wheat prices higher due to the feed component, and it will pull soybean prices higher because of the acreage situation here in the U.S. this upcoming spring.
Cattle market ended lower after making some new highs, new contract highs once again. Is this just routine profit taking, or did we do some technical damage that might signal a top?
Did not do technical damage. Certainly on a day like today, we could have threatened what's called a key reversal, which would be a new contract law high, and then settling below the previous day's low. Did not do that in the cattle. So we didn't do anything technically of any major importance. The feeder cattle came close. We have to mention that the feeder cattle were within about 17 cents of putting in a key reversal. But once again, it did not do that either. And so, I just think we have to realize that, the funds are long. We are extraordinarily highly priced. And we're going to have this choppy, volatile kind of trade where we get days of profit taking. I think that's what we had today. Also have to mention that, Friday afternoon, we are going to get the inventory report. We used to get it semi-annually. Now we only get it annually. And because we only get it annually, it has the potential for, some surprises. And that in and of itself is probably a good reason why we saw some profit taking today and why we may see some more profit taking tomorrow and Friday.
Yeah. Plus it is end of the month, so you might be getting some profit taking just as a result of that. The hog market has felt like it's been following cattle to some degree, although cash improvements have been helping out. Yep. Where do you see the hog market going here ultimately?
Well, of course, the easy answer is, well, the cash is going to determine that. But this is the time of the year when we generally see cash prices start to improve anyway. Okay. And so there's some seasonality that would suggest that hog prices should probably start to improve in the cash market. Then we start contemplating the huge discount that pork now has as a value relative to beef. And, it's kind of hard to see the hog market pulling back all that far. Once again, funds are very long, the hogs as well. And so, I wouldn't be surprised if you ended up with a $10 or $20 correction in cattle prices, which is, you never know when that's upon us, that we might not get something similar in the hogs as well. But, honestly, seasonality says that, hogs are probably well supported, and the discount to the beef probably keeps it supported as well.
Absolutely. Plus the disease issues that we've been hearing out in the country, perhaps. Let's wrap up talking about the Fed met today, the last 2 days, in fact, and left interest rates unchanged. That really was not a surprise, was it?
No, in fact, I think the odds going into today's session were like 98% that the Fed was not going to do anything. Right now, everybody's wondering about March and what's going to happen is that the press conference, which is actually ongoing, is probably going to be parsed for the statements from Fed Chairman Powell as to what the next move is going to be. There was about a 30% probability going into today's session that first rate cut will probably come in March. And, the question for everyone is, how many cuts are we going to have? Right now, I think the Fed is going to be very very willing to watch data continue to come by and see if lower rates ultimately are needed to support the economy. But the economy has been running hot enough. Job growth has remained good enough that I do think that it may take some time for us to see another interest rate cut.
Okay, and we'll see if the president is upset about that or not. I know he
He
wanted a
will.
cut today. Yeah. Okay. Thanks so much, Kent Beadle with Paradigm Futures. Remember, futures and options do have substantial risk. This is Markets Now.